Something is wrong when a paycheck grows. The economy is called resilient, and a routine grocery run still feels like a small financial emergency. Millions of Americans are not imagining that pressure. The numbers show a long squeeze hiding beneath calmer headlines. This is not a claim that every family is ruined, or that every price increase is a conspiracy. It is a look at 15 hard facts that explain why ordinary life now demands more money, more planning, and more sacrifice than many official summaries suggest. By the end, you will see how inflation, housing, debt, healthcare, and even the design of a supermarket work together. You will also see why a lower inflation rate can coexist with a household budget that still feels permanently damaged. The evidence comes from federal price data, household surveys, credit reports, housing research, and consumer protection investigations. The point is not panic. The point is to connect facts that are usually reported separately, even though families experience them all at once. The first fact is the one people feel but often struggle to explain. Inflation slowed, yet the old price level did not return. A slower climb is still a climb, and a mountain does not disappear because the slope becomes gentler. By June 2026, the broad consumer price level was roughly 29% higher than it had been in January 2020. That means a basket costing $100 at the start of the decade would cost about $129 now. Put differently, the dollar in a checking account buys substantially less of the ordinary economy than it did 6 years earlier. Unless income and savings rose at the same pace, the household lost purchasing power even if the account balance looked unchanged. That erosion is easy to underestimate because no single receipt contains the whole story. The increase is scattered across hundreds of transactions, renewals, service calls, premiums, co-pays, subscriptions, and household repairs. That loss does not appear as a single invoice, which makes it easier to normalize and harder to reverse. That comparison is not a forecast or a political slogan. It is the accumulated effect of year after year of higher prices. The most painful part is that wages, tax brackets, savings, and household habits do not all adjust at the same speed. When inflation falls from a high rate to a lower rate, prices usually do not fall. They simply rise more slowly. So the household hears good news while paying a permanently higher base price for rent, food, repairs, insurance, and basic services. Economists call that disinflation, not deflation. The distinction sounds technical, but it changes the meaning of every optimistic headline. Improvement can mean the pressure is growing more slowly, not that affordability has been restored. Once a new price becomes familiar, consumers stop comparing it with the old price and begin comparing it only with the newest increase. This is why people can be told inflation is improving and still feel poorer. The statistic describes the speed of change. The family budget feels the total distance already traveled, and that distance has been enormous. A worker who received a raise may have only caught up with part of the increase. A retiree may have adjusted spending instead. A young adult may never have experienced the earlier price level, only the new barrier to entry. Official inflation is also an average built from national spending patterns. A family devoting more of its income to rent and groceries can feel a stronger squeeze than a household spending more on categories where prices changed less. The household may adapt successfully and still be worse off, because adaptation often means accepting less rather than regaining purchasing power. The second fact is even more personal. Grocery prices rose faster than the overall price level. By June 2026, food bought for home was about 32% more expensive than in January 2020. That change does not arrive as one dramatic charge. It appears as 50 cents here, a dollar there, a smaller package, a missing sale, a higher unit price, and a weekly total that quietly crosses a line the shopper once considered unacceptable. A weekly bill that rose from $150 to nearly $200 does not feel like a data point. It feels like one fewer restaurant meal, a canceled activity, or another purchase moved to the credit card. Food is also difficult to postpone. A household can delay a vacation or a new television. It cannot indefinitely delay breakfast, school lunches, dinner, cleaning supplies, and the small household items bundled into the same shopping trip. Food inflation also reaches beyond the kitchen. Higher restaurant and takeout prices raise the cost of birthdays, work lunches, travel, and the small social routines that make life feel normal. The pain is uneven. Beef can rise while eggs fall. Coffee can jump while dairy stabilizes. The official category averages those movements, but the shopper who buys the rising items feels a much harsher personal inflation rate. Even within the same aisle, the experience depends on diet, region, season, allergies, and family size. A household cannot always swap one item for another without affecting health, culture, time, or what children will actually eat. Families respond by trading down, buying less protein, skipping fresh items, stretching leftovers, or visiting several stores. Those choices can reduce the receipt, but they cost time, fuel, variety, and often dignity. Visiting multiple stores can save money on paper, but the calculation changes after gasoline, transit, extra mileage, and an additional hour are counted. The cheapest shelf price is not always the cheapest total cost. The third fact is that the package itself can hide part of the increase. Product downsizing means the price stays similar while the amount inside shrinks, raising the cost per ounce, sheet, serving, or count. Government researchers found that downsizing was not the main cause of overall inflation. That matters. Blaming everything on shrinkflation would be misleading because most of the price surge came from broader forces. But the same research found that size changes mattered much more in certain categories, including cereal and household paper products. In those aisles, the box or roll can look familiar even when the value has changed sharply. Researchers estimated that downsizing added little to the overall rise in consumer prices from 2015 through 2024. Yet in the most affected categories, smaller sizes made a noticeable contribution to the price increase shoppers experienced. That is why shoppers often miss it. Human memory tracks the package color and shelf price more easily than the net weight. A container can keep the same height, add a deeper bottom, or change its count without announcing the loss loudly. Shrinkflation matters psychologically because it breaks the shopper's reference point. The same-looking package no longer represents the same amount of food, paper, soap, or household use. The best defense is the unit price, yet unit labels are not always easy to compare. One shelf may show price per ounce, another per count, and another per 100 units. Confusion protects the higher margin. A household that compares only sticker prices can therefore choose the apparently cheaper package and still pay more for each usable unit. The store wins the comparison before the shopper realizes the comparison was framed incorrectly. The fourth fact is that rent has climbed by roughly 1/3 since January 2020. By June 2026, the national rent index was about 32.5% higher than at the start of the decade. Rent increases hit differently from grocery increases because they arrive in one large monthly demand. A household cannot substitute a cheaper apartment as easily as it can substitute store-brand pasta for a national label. Moving requires deposits, application fees, transportation, time off work, and a new commute. In tight markets, the cheaper unit may be farther from jobs, schools, childcare, medical care, and family support. Nearly half of renter households were spending more than 30% of income on housing costs in 2023. That is the standard threshold for being cost-burdened, and it represented more than 21 million renter households. More than 1 in 4 renter households was severely burdened in that period, meaning housing consumed more than half of income. At that point, a normal utility bill or car repair can become a direct threat to keeping the lease current. Once housing consumes that much, every other category becomes the adjustment valve. Food gets cheaper, healthcare gets delayed, retirement contributions stop, car maintenance waits, credit cards become the bridge. Rent burden can persist even after wage gains because leases reset in large steps, while pay raises may arrive slowly, irregularly, or not at all. Housing pressure also changes geography. Families move farther from opportunity, accept longer commutes, double up with relatives, remain with partners for financial reasons, or stay in units that no longer meet their needs. The fifth fact is that buying a home has not been an easy escape. High prices and elevated mortgage rates combine to make the monthly payment on a typical home much harder to qualify for than it was only a few years earlier. A median income family can look stable on paper and still struggle to assemble a down payment, closing costs, moving expenses, repairs, insurance, and an emergency reserve. Qualifying for the loan is not the same as safely affording the life around it. Property taxes, maintenance, association dues, and insurance do not disappear when the mortgage closes. A payment that barely fits at purchase can become unsafe when the roof, air conditioner, or premium changes. Homeownership costs also vary sharply by region. Insurance premiums, taxes, storm exposure, and local repair costs can turn the same purchase price into very different monthly realities. Owners with older fixed-rate mortgages may be protected from rising interest costs, but that protection can trap them in place. Selling a low-rate home and buying another can mean accepting a much larger monthly payment. This creates a divided housing economy. Long-time owners may hold valuable assets and low payments. New buyers face high entry costs. Renters face rising rents without receiving the wealth gains that homeowners may enjoy. The result is a strange lockout. People who already own may feel wealthier because the asset appreciated, while people trying to buy must save against a target that moved faster than their down payment. The sixth fact is that housing and transportation together consume just over half of average household spending in 2024. Those are not luxury categories. They are the price of having a place to live and a way to reach work. Average spending on housing alone was more than one-third of the household total. Transportation took another large share. Before food, healthcare, debt payments, or childcare enter the picture, much of the budget is already committed. This explains why small percentage increases in rent, insurance, fuel, repairs, or car payments feel so destructive. They strike the largest categories, where even a modest change can erase an entire month of discretionary money. Transportation is especially unforgiving in places built around driving. The vehicle is not merely a possession. It is access to income, childcare, groceries, and medical appointments, which makes repairs difficult to refuse. The seventh fact is that wage headlines can conceal weak purchasing power growth. In the year ending June 2026, real average hourly earnings for all private workers increased by only 0.1%. For production and non-supervisory workers, real hourly earnings slipped by 0.1% over that same year. In other words, many workers were running hard just to remain in nearly the same place. That tiny real change means the average wage increase was almost entirely absorbed by higher prices. For many lower-paid workers, the purchasing power of an hour of labor did not improve at all. Nominal pay can rise while real pay barely moves. The paycheck number is bigger, but so are the prices it must cover. That gap is why a raise can feel strangely invisible after rent, groceries, and insurance are paid. Median household income in 2024 was about $83,730, and the Census Bureau found no statistically significant change from the year before after adjusting for inflation. Household income can also rise because more people work, more hours are added, or a second job appears. A higher household total does not necessarily mean each worker became better paid or gained more free time. Averages do not reveal how many households had to add hours merely to keep income steady. More labor can preserve the budget while reducing the time available to live. That does not mean every household made that amount. Median means half were above and half below. It also does not account for the different costs of living in Boston, rural Mississippi, Phoenix, or coastal California. A household can therefore be above the national median and still feel cornered. Local rent, childcare, commuting, insurance, and taxes can consume the apparent advantage before the family experiences any real comfort. The national median is before taxes and says little about debt. Two households with the same income can live completely different lives if one owns a home outright and the other carries rent, childcare, student loans, and medical balances. The eighth fact is that many families have almost no room for surprise. In the Federal Reserve's latest household survey, 37% of adults could not cover a $400 emergency entirely with cash or its equivalent. Some would use a credit card and carry the balance. Some would borrow from family. Some would sell something. 13% said they could not pay the expense by any method at that moment. The survey treated a credit card paid in full at the next statement as cash-like, So the 37% figure is not simply people without literal bills in a wallet. It captures households unable to resolve the shock without borrowing, selling, or going without. $400 is not an exotic crisis. It can be a tire, a dental problem, a broken appliance, a school expense, a deductible, or a short paycheck after missed hours. When a small shock requires debt, the shock does not end when the bill is paid. Interest extends it into future months, where it competes with groceries and rent and makes the next emergency harder to absorb. A $400 balance carried at a high card rate can keep generating interest long after the tire is replaced. The repair becomes a recurring line in the budget, and the next surprise lands before the first one is gone. The ninth fact goes deeper. 30% of adults said they could not cover 3 months of expenses by any means if their main income disappeared. That is not a minor savings gap. It is structural fragility. Job loss is therefore not just a labor market event. It can quickly become a housing event, a healthcare event, a credit event, and a family emergency. The same household can move from stable to desperate in a few pay cycles. Emergency savings are difficult to build when the budget has no genuine surplus. Telling people to save more is sensible advice, but it becomes hollow when every month already requires choosing which obligation gets delayed. Saving advice often assumes a stable gap between income and expenses. For many households, that gap exists only in months without illness, school costs, travel for family, home repairs, or reduced work hours. Financial fragility changes behavior before an emergency occurs. People avoid appointments, ignore warning lights, and postpone maintenance because discovering the problem may create a bill they cannot pay. The 10th fact is the scale of household debt. By the end of 2025, total household debt reached about $18.8 trillion, up roughly $4.6 trillion since the end of 2019. Debt growth is not automatically proof of distress. Mortgages can finance homes, student loans can finance education, and auto loans can provide access to work. But large balances become dangerous when incomes and assets are uneven. The debt total also reflects unequal capacity. A wealthy household may carry a large mortgage backed by a valuable home. A struggling household may carry a much smaller card balance that consumes a dangerous share of monthly income. Credit card balances alone reached about $1.28 trillion. Credit cards are uniquely painful because the interest rate can turn an ordinary purchase into a long-term expense. Card borrowing is also expensive precisely when households are most vulnerable. Rates are usually far above mortgage or auto loan rates, and unlike a fixed installment loan, a revolving balance can remain open indefinitely. A family that charges groceries is not necessarily reckless. It may be using the only available bridge between a fixed bill date and a paycheck that no longer covers the full month. But the bridge charges tolls. Interest compounds, minimum payments preserve the balance, and one late payment can trigger fees and credit damage. The household pays more precisely because it had less cash at the start. Debt can keep consumption stable for a while, which makes the economy look stronger than the household balance sheet. The spending happens now. The strain arrives later. Minimum payments create an illusion of manageability. The account stays current, but little principal may disappear. A household can pay faithfully for months and still feel as though the balance barely moved. The 11th fact is the return of serious student loan stress. Outstanding student loan debt stood near $1.66 trillion at the end of 2025. About 9.6% of student loan balances were at least 90 days delinquent in that quarter, reflecting the renewed reporting of missed payments after the long pandemic-era pause. The delinquency figure is a warning, not a complete measure of hardship. Borrowers who remain current may still cut food, housing quality, healthcare, or retirement saving to protect the loan from default. Student debt reaches far beyond recent graduates. It can delay homeownership, reduce retirement saving, shape career choices, and follow parents who borrowed for children. The degree may be completed, but the payment remains. The cruelest part is the mismatch between certainty and outcome. The loan payment is fixed by contract. The higher income promised by education is not guaranteed, especially when borrowers leave school without completing a credential. Education remains valuable on average, but averages cannot make an individual payment. Borrowers face specific wages, specific employers, specific health problems, and specific local housing costs. Student loan distress also affects families indirectly when parents provide housing, cash, childcare, or loan payments for adult children who cannot absorb the obligation alone. The 12th fact is that healthcare can create debt even for people who are insured. Deductibles, coinsurance, out-of-network bills, prescriptions, dental care, and time away from work can turn illness into a financial event. As of June 2023, about 15 million Americans still had medical bills on their credit reports, totaling more than $49 billion in collections. The average remaining reported medical balance had risen above $3,100 because smaller debts were more likely to be removed. The people left in the data tended to carry larger, harder problems. Removing some medical collections from credit reports did not erase the underlying bill. A debt can disappear from one scoring system while the patient still receives calls, payment demands, or pressure to enter a financing plan. Medical billing is especially punishing because the consumer often cannot compare prices calmly. The purchase may happen during pain, fear, or urgency, when shopping around is unrealistic or impossible. Even when a bill is wrong, disputing it requires time, records, phone calls, and persistence. That administrative burden falls hardest on people already dealing with illness, caregiving, or reduced income. The complexity itself has economic value for the biller. A consumer who cannot understand the explanation of benefits, code, network rule, and assistance policy is less able to challenge the amount before paying. Healthcare debt carries a special moral pressure. People may agree to payment plans they do not understand because refusing feels like rejecting care, recovery, or responsibility to a loved one. The 13th fact is that the average household is giving more of life to work and logistics. In 2025, more than 15 million employed people held multiple jobs, according to federal time use data. Not every second job is a sign of hardship. Some people freelance by choice or pursue a passion. But when the extra work is needed for rent, food, or insurance, the cost is measured in sleep, family time, and recovery. Scarcity of time also changes buying behavior. A tired worker is more likely to pay for prepared food, delivery, smaller convenience packs, or the nearest store rather than the cheapest store. That is not laziness. It is a trade between money and time. The economy can punish people twice, first by making them work longer, then by charging them more for the convenience their schedule now requires. Convenience spending is often criticized as a character flaw, but the schedule came first. When commuting, caregiving, and multiple jobs consume the day, cooking from scratch becomes another unpaid shift. The 14th fact lives inside the grocery store. Shelf placement, package design, promotions, and store layout are built to influence what enters the cart, often before the shopper makes a conscious comparison. High-margin products receive prominent displays. Impulse items sit near checkout. End caps look like bargains even when the price is ordinary. The store knows that visibility can beat value. Prominent placement is powerful because shoppers treat visibility as information. A large sign feels like proof of value, even when the unit price is higher than a quieter option a few feet away. Loyalty card discounts can be real, but they also divide prices into two tiers. The shopper without the card may pay more, while the shopper with the card creates a detailed record of purchases. That data can improve coupons and inventory planning. It can also help retailers and pricing vendors segment customers by habits, location, responsiveness, and willingness to pay. Loyalty systems can personalize genuine savings, yet they also teach the retailer which households wait for discounts, which buy at full price, and which products trigger a larger basket. The Federal Trade Commission has found that pricing intermediaries can use browsing history, location, purchase behavior, and even abandoned online carts to shape prices or the products people are shown. That does not prove every supermarket charges every shopper a secret personal price. It does prove the technology and incentives exist, and that the line between a helpful coupon and behavioral pricing is becoming thinner. The central concern is not that every price is secretly individualized today. It is that detailed behavioral data can make price discrimination easier, less visible, and more difficult for consumers to challenge. Digital coupons add another barrier. A sale may require a phone, an account, an app, a password, location permissions, and the patience to clip an offer before checkout. The customer who lacks time, data service, technical comfort, or a working phone can pay more for the same item. A discount system can therefore reward the organized while taxing the rushed. Older adults, low-income shoppers, and anyone managing a disability can be especially disadvantaged when the lowest price is locked behind a digital task. The shelf says "sale," but the register decides whether the shopper completed the maze. Private label products often offer real savings because they carry less advertising expense and can be sourced directly for the retailer. But cheaper does not always mean worse, and premium packaging does not always mean better. Still, stores now create premium private labels too. The bargain shelf can become another ladder of good, better, and best, inviting shoppers to trade up inside the store's own brand family. Because the retailer controls the shelf, packaging, promotion, and placement, its own labels can be positioned as the obvious answer to expensive national products. That can save shoppers money while also giving the store more control over margins. Coupons create a similar trap. Saving money on an item is useful only if the item was already needed and the final unit price is competitive. A discount that expands the basket can raise the total bill. Multi-buy offers exploit the same weakness. 2 for a lower combined price may be a bargain, but only when the product will be used. Otherwise, the shopper converts cash into pantry inventory and possible waste. Bulk offers can also favor households with space, transportation, and spare cash. The shopper who can buy a large quantity receives the lower unit price. The shopper living paycheck to paycheck pays more for a smaller amount. Premium products also act as anchors. A very expensive option can make the merely expensive option feel reasonable. The comparison changes even though the household budget has not. Convenience packaging carries its own tax. Pre-cut fruit, single servings, snack packs, and ready-to-heat meals often cost more per unit because labor, packaging, and speed are built into the price. For a caregiver, disabled shopper, exhausted parent, or worker between shifts, that convenience may be necessary. The higher unit cost is not simply poor discipline. It can be the price of functioning. The same pattern appears outside food. People with storage, equipment, stable schedules, and cash can buy in bulk, maintain possessions, and plan ahead. People without those buffers repeatedly pay the premium for immediacy. Store layouts add friction to comparison. Frequently purchased staples may be spread across the building, encouraging exposure to more displays. Seasonal items appear in traffic paths. Small temptations accumulate. Ordinary shoppers miss these patterns because they are trying to solve several problems at once. Remember the list, manage children, compare prices, answer messages, watch the time, and stay within a mental budget. Retail strategy works because attention is limited. Nobody can inspect every ounce, ingredient, fee, loyalty condition, expiration date, and alternative while also trying to finish the trip before work or bedtime. Retail pricing thrives on small decisions. No single end cap, coupon, app prompt, or package change ruins a budget, but dozens of tiny nudges can redirect a meaningful share of monthly spending. The 15th fact is that delivery apps and online ordering can turn convenience into a layered bill. The menu price may be higher than in the store, then service fees, delivery fees, taxes, and tips arrive. Subscriptions can reduce one fee while encouraging more frequent orders. Free delivery is not the same as free service, and the easiest checkout screen often hides the most expensive habit. A $0 delivery label may sit beside a service fee, a small order fee, a local charge, and a tip prompt. The language emphasizes what disappeared while the final total reveals what remained. Online grocery carts can also weaken price awareness. The customer sees a running total, but substitutions, variable weight items, temporary holds, and last-minute fees can change the final charge. At the same time, online ordering can reduce impulse purchases and help some households track totals. The tool is not automatically bad. The danger is assuming convenience has no price. For some disabled people, caregivers, and households without reliable transportation, delivery is access rather than indulgence. The fair question is not whether convenience should exist, but whether its full price is clear before commitment. The larger pattern is that companies compete not only on sticker price, but on attention, data, urgency, and habit. The customer is making choices inside a system carefully designed to increase the value of each transaction. This is where the official story and the lived story separate. Economic reports speak in averages. Averages are essential, but no family buys the average basket, pays the average rent, or receives the average medical bill. A young renter buying groceries and paying student loans can face a much higher personal inflation rate than an older homeowner with a paid-off house and rising investment assets. The economy can therefore improve in aggregate while a large group remains under pressure. Growth can be real, employment can be real, corporate profits can be real. Household pain can also be real. Another uncomfortable truth is that higher asset prices help people who already own assets. Home values and stocks can strengthen one family's balance sheet while raising the entry price for the family still trying to begin. This is not proof that every gain is unfair. It is proof that the starting position matters. Inflation punishes cash savings, high housing costs punish renters, and high interest rates punish borrowers more than lenders. That difference compounds. The household with assets may borrow on better terms and earn returns. The household without assets may borrow at higher rates and pay fees, widening the gap even when both work hard. The average American is not a single person. It is a statistical center surrounded by workers, retirees, owners, renters, parents, students, caregivers, and people with very different exposure to the same economy. But the facts point in one direction. The cost of basic participation rose faster than many households could comfortably absorb, and the adjustment was pushed onto debt, time, quality, savings, and future plans. The pressure is cumulative because each higher monthly bill reduces cash available to absorb a later increase, turning routine changes into a broader chain reaction. People downgraded food, postponed care, delayed children, stayed in unwanted jobs, skipped repairs, moved farther out, took extra work, or accepted higher debt. Those choices rarely appear together in one headline. They do appear together in real life. The grocery bill affects the credit card balance. The rent affects the medical decision. The commute affects the time available to cook. The second job affects the need for delivery. That is why blaming households for every bad outcome misses the system. Personal choices matter, but choices are made inside prices, wages, schedules, market power, and rules that individuals do not control. It is also why blaming one company, one president, or one policy for everything would be dishonest. The squeeze reflects pandemic disruptions, demand shifts, labor shortages, housing scarcity, interest rates, insurance costs, market concentration, and pricing strategy. Some pressures are easing, some wages have caught up, some prices have fallen. Some households are doing well. Accuracy requires saying that clearly. But easing is not reversal. A family that drained savings during the surge does not regain those savings because inflation slows. A renter who accepted a higher lease does not receive the old rent back. A borrower who carried a balance through the worst months is still paying interest. A delayed dental problem may now be larger. A missed retirement contribution loses years of compounding. This is the hidden damage. Not only what people paid, but what they could not build. Emergency funds, home equity, education, health, rest, and confidence were all crowded out. Lost compounding is invisible but powerful. A year without retirement contributions does not only remove that year's deposit, it removes every future gain that deposit might have earned. The strongest defense begins with seeing the mechanisms. Compare unit prices, not package familiarity. Treat loyalty discounts as a trade involving data. Check whether a coupon lowers the basket or merely enlarges it. Separate convenience from necessity. Use delivery when it solves a real constraint, not because the app removed every moment of friction. Compare the final total, not the advertised fee. Build a grocery list around flexible ingredients, but do not pretend meal planning can overcome a housing payment that consumes half of income. Household discipline cannot substitute for affordable systems. Most important, stop confusing lower inflation with restored affordability. Prices can stabilize at a level that remains painfully high. The rate can improve while the damage remains on the balance sheet. These 15 facts do not say Americans are helpless. They say the struggle has a measurable structure, and understanding that structure is more useful than shame. The economy did not hit every person equally, but it raised the admission price of ordinary life. Food, rent, transportation, healthcare, and debt now claim more attention before a household can even think about progress. That is the real divide, not between people who work and people who do not, but between households with buffers and households one repair, one illness, or one rent increase away from a cascade. Remember the central lesson. Inflation is cumulative. Housing locks in pressure. Debt carries yesterday's shortage into tomorrow. Convenience is often priced as a premium. Data can influence what shoppers see and pay. And the checkout line is only the visible end of the story. Behind the total are wages that barely gained ground, savings that never formed, time that disappeared, and opportunities quietly postponed. If this helped connect the headlines to what your household actually feels, like the video and share it with someone who keeps hearing that everything is fine. Then comment with one specific answer. What expense has changed your life the most since January 2020? Housing, groceries, insurance, healthcare, transportation, debt, or something else?